I remember I was at an annual options industry conference not that many years ago. I mean, I'm thinking about 10 years ago. And one of our speakers, through a show of hands, said, what year going forward, and it was like over the next 3 or 4 years, will the options industry average 10 million contracts a day? And like a lot of people just wouldn't raise their hand at all because they just didn't think we'd ever get there. And now I think the average daily volume across the industry is like 55 million options a day. And on a notional basis, it's billions, if not trillions of dollars that trade in options every single day.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 26, where we have a super special guest. Our guest today is a senior executive with a distinguished 40-year career, uniquely with one employer, CBOE Global Markets. His last role was leading international strategic development. During his tenure, he led all exchange business development activities, created and implemented strategic plans, ran and established business lines, developed and managed multi-million-dollar budgets, and led a team of 150 plus professionals. He began his career in 1983 and served in trading operations, regulatory services, strategic planning, business development, and corporate strategy roles. In all, he served in 21 distinct roles in his career, each of increasing responsibility. Additionally, he served on several for-profit and nonprofit boards and committees. Currently, as president of ABLL Markets Advisory LLC, he's serving as president of Thames Health Resource Service Management, a senior advisor to Adaptive Financial Solutions, a fintech startup, and to Ironbound Advisors, a boutique investment bank, and to Wilson Innovators, a consulting firm specializing in M&A activity. Yes, he is in demand. Please welcome this pretty impressive individual, my friend and occasional neighbor, Andy Lowenthal.
Thanks, Dan. I guess you must have somebody else lined up today because that sounded way beyond what I actually do.
So, Andy, how's it been going, man? Have you been spending a lot of time in New Buffalo lately?
Yeah, so Dan alluded to our occasional neighborhoodishness. We both happen to have places in New Buffalo, Michigan, although for some reason we somehow managed to not see each other very much. My wife and I, Tracy, have been going back and forth this summer, taking advantage of all the activities and fun up there with the hot summer that we've been experiencing. Having a pool and a lake within a stone's throw away is actually a really nice thing to have at your fingertips or at your disposal.
So let's get into it a little bit here. So, Andy, you've kind of seen it all in the options industry, from humble beginnings on the trading floor to advising CEOs and helping literally steer the course of the industry as one of the creators of this $1 trillion industry. You're the guy who knows where the bodies are buried.
Hmm.
Let's go to the Wayback Machine and let's talk about how you got started in this business.
Sure. So 1983, coming out of school, one of those lost souls, like many of us were at that stage of our lives. Had a good friend working down at the trading floor of the then CBOE. And he's like, you should just get a job down there. It's a cool place to work. So I found the employment office in the Chicago Board of Trade building and I went in and filled out an application and they had me sit down and take a fractions test because back in 1983, everything was traded in sixteenths in the equity and cash and security options world. So my ability to add and subtract fractions in increments of sixteenths, qualified me for my price reporter role on the trading floor. Just for fun, my original salary was $700 a month. And from there, here I am in 2025, looking back on a 40-year run at that single employer.
Holy cow, man. Isn't that crazy?
It is crazy. I was as I tried to represent in what you read as my bio, I saw a lot. We were all paper back in the early days, fully open outcry paper environment. I spent the early part of my career in the training department. A lot of that was vocational training as people came into the business for the first time, doing things like price reporting, quote reporting, clerking. But we also did a lot of technology training as the exchange advanced their technology and things like the introduction of the electronic book and auto quote and different things that eventually became kind of the core for what now is the business, which at CBOE is called the hybrid trading system, which is a combination of open outcry and pure electronic trading. I was there for all that and pretty integral part of seeing how they get developed.
Wow. Wow. So since then, you've been pretty much all over the world helping exchanges and brokers and trading firms to get options businesses up and running. Where were some of the more interesting or surprising places you found yourself proselytizing the benefits of option trading?
So one of the roles I had was a role in a division or department of the CBOE called Strategic Planning and International Development, or acronym SPID, which is a terrible acronym, by the way. And at that time, our chairman was a gentleman by the name of Duke Chapman. And Duke Chapman had come to CBOE from Barclays, London, and he saw how much more developed the derivatives and specifically the options markets were in the US versus the rest of the world. And he made a commitment internationally that he would help exchanges develop their options capabilities. And myself, and at the time, my boss, Dr. William Barkley, came up with this effectively a white paper. It was a way of measuring, at least from our perspective and view, what made a cash equity market and a developing market in a position to be able to launch an options capability. And we literally would fly around the world and spend time with exchange management at different parts of the world and go through this assessment and decide if it made sense. And then if it did, we would go continue to help them. So some of the more unique places to directly answer your question, I went to Kuala Lumpur twice
Wow.
on behalf of CBOE, and there was an exchange operator there called the CLOF, the Kuala Lumpur Options and Financial Futures Exchange. I spent 3 weeks there on ground working with the very able and eager and staff, and we helped them develop their capability. That was in 1994, so it's going back a few years. One of my other more exciting trips was in 1997. I got to go to the Prague Stock Exchange, and this is just a few years after Czech Republic had come out of Soviet dominance, and they were very eager to develop their financial markets. And I spent a couple of weeks there working with people there. So that was an amazing experience. And then as time went on, as my role changed and I became much more focused on CBOE business development and less on this type of strategic plan and international development, I traveled significant places around the world. I spent a lot of time in Singapore. I went to China 3 times, a tremendous amount of time in London. In fact, one of the things that I was able to do was open for CBOE, the first international business development office, which was in London in the early 2000s. And we which is a two-man operation that eventually morphed into a part of our bigger acquisition that we did in the mid 2000s when CBOE acquired the BATS exchange, who had a European operation already in place. In my last role at CBOE, you referenced the role as international business development. I was charged with identifying opportunities for CBOE, similar to what we had done in London, where we could have a bigger presence, where in the past we had little or no presence. And that led me to places like Brazil, Dubai, Israel, on chart, but none, unfortunately never was able to get over there, mostly because of COVID. South Africa and other countries other more developed parts of the APAC regions, which we now have an office in Singapore as well. So saw a lot of the world, as you referenced, proselytizing the use of options, and with the idea always being, as people understand and how to use products like options in their portfolios for income creation or hedging, downside hedging, whatever it is that they're doing, speculating in some cases, that could and we would hope lead to the use of our products at CBOE, particularly our proprietary products, the S&P and VIX and other products that were uniquely traded just on CBOE.
Yeah, and I think probably a lot of our listeners don't realize SIBO, like they have, I mean, they own exchanges kind of all over the world, right?
They do now, yeah.
Yeah.
Yep. In the last few years, we worked my last few years, so through the beginning of last year, there was a focus on international expansion. So through acquisitions, we created presence in Australia, Japan, Canada, and Brazil. None of them, at least initially, had options capabilities. They were all cash equity markets. But since then, Cboe's opened the Cboe European Derivatives Exchange, or CEDX, and has their eyes set on opening addition, I assume, although I'm not there to actually know this, but I would assume that eventually options capabilities in some of those other markets as well.
Wow. Wealth building with options focuses mostly around how investors can grow wealth faster by using options as part of their long-term investment strategy, mostly using covered calls and cash secured puts. How have you seen that use case for options evolve over the years? Over the years that you've been involved with CBOE.
Yeah, so we used to measure, we still do measure the percentage of accounts that have options capability or suitability versus the total number of accounts that are out there. And we used to count those, that number used to be in the single digits, like literally as small as 1 or 2%, meaning for every 100 open securities accounts, only one or two would have the ability to trade options because of suitability requirements. And over time, that number's just increased. I don't know what the exact number is now, but I'm sure it's north of 50% or right around that 50% number and growing as we've seen the explosion of self-directed retail firms and the capabilities that they put on their websites to give retail investors the tools they need to make wise decisions on how to use options in their portfolio is relatively new. I mean, again, when I first started, it was, an occasional advisor that would understand options and have their clients use them. But the concept of self-directed was really barely just starting. And now between, Charles Schwab and TD and Thinkorswim and Tasty Trade and all these great retail firms and just the tools at your fingertips is it's incredible compared to when I first started in the business.
Yeah, I remember back in those days. I mean, when I got started, a little bit after you, but not terribly much, I guess, that there were the commercials for full service brokerage firms. Like that was the normal thing. Like your stockbroker would call you up with a hot tip.
Right. Right. One of the things that I should have said from the beginning and where you started where we got to meet each other originally and where, but was always core to SIBO was the importance of education. SIBO started in the early 1990s, I believe, the Options Institute, full-time dedicated professionals like yourself that were going around and talking to clients, advisors, at the time what they used to call stockbrokers, and teach them the benefits of having options in their portfolio and using options the way that they want, the way that they or their clients could most benefit. One of the things I always like to say about options is it's the one tool that you can express, you can have a view either by doing research or just watching CNBC or Bloomberg TV and get a view on a stock, and you can execute that view using options. And again, you can get if you think a stock's going to go down, you can go out and buy some puts. If you think a stock's going to go up, you can leverage that a little bit and buy some calls. You can take a view on how much time you think a move's going to take place. buying options set to a set expiration. One of my favorite uses of options is, and one of the things that I'm going to take partial credit for, is the creation of flex options, which occurred in the 1990s. And, in the 1990s and even through today, there's a lot of people who get stock either in their compensation or have big, outstanding long-term positions in stocks. They don't necessarily want to sell the stock, or in some cases they can't sell the stock because they have restrictions on what they can do with the stock, but they can use flex options to down to the day and down to the current price of the stock, either up or down from there, depending on how much risk they want to be exposed to, protect themselves by using flex options. So if I had 1,000 shares of XYZ stock that's restricted for the next 1 year, I could buy a downside put for that's going to expire in exactly 1 year from today. And I can say, I really don't want to go below 10% of the current value. So if the stock's trading at 100, I could buy the 90 put, expiring exactly 1 year from today. And I can go to sleep every night knowing that I have that protection in place. And something like that is just so powerful.
Yeah, it really is. And I think a lot of people don't realize that that's out there, that that's a thing.
Yeah, no, for sure. And more people are realizing that. Like we both know, adoption of options is only on the upswing. I remember I was at an annual options industry conference not that many years ago. I mean, I'm thinking about 10 years ago. And one of our speakers, through a show of hands, said, "What year going forward?" And it was like over the next 3 or 4 years, will the option industry average 10 million contracts a day? And like a lot of people just wouldn't raise their hand at all because they just didn't think we'd ever get there. And now I think the average daily volume across the industry is like 55 million options a day. And on a notional basis, it's billions, if not trillions of dollars that trade in options every single day. It's incredible the explosion that we've seen in the space in the last now several years.
That really is amazing. And like flex options too, like the volume on that has peaked up quite a bit too, which is
For
weird.
sure. So flex options, 1993, we started flex options. The initial use of flex options was by the bigger banks. There were a couple asset managers that were using them for some cash creation, selling calls against portfolio. But a lot of early adopters of flex were banks who couldn't get the proper OTC paperwork in place, what they call the ISDA agreements. So client A, who was a very good client, but for some reason might have not been able to qualify for an ISDA agreement with the bank. So then they would use the balance sheet of the OCC because flex options, even though they have the elements of OTC trading, because you can set your own strike price and your own expiration date, they are, from the purpose of clearing, just like listed options. They trade on exchange. They're booked to the OCC. They're novated so that the counterparties are with the both facing the OCC, not each other anymore. And there's a secondary market. So if you wanted to get out of your flex option, you just go back to the market. You don't have to go to the original party that you did the trade with. And it brought in whole new level of liquidity to that OTC type of trading because the CBOE, not just the CBOE, but the exchange market makers across all the exchanges were willing to reply to requests for quotes for those flex options. And now today, what's happened, particularly in the last several years, is this introduction in the ETF space of what they call these buffer protected ETFs. And the buffer protected ETFs, very oversimplifying, is an exposure to an underlying index. In most cases, the S&P, but there's certainly ones written to Russell and Nasdaq and the other U.S. indices. And built into the strategy as a single trade is a downside put, which several ETFs have lots of different downside protection numbers. You can go down 15%. You can be protected down to 15%. And then if the market drops even further, you might start reparticipating in the downside because what the ETF is doing is buying a downside put and then selling a deeper downside put to fund the higher strike downside put. In other cases, they're doing basically a collar trade so that the downside put is funded by an upside call. So you've kind of capped your upside, but in return for that capped upside, you've reduced the cost of your downside hedge protection. So these ETFs have taken off and almost all of them use flex options. So flex options are a real thing. I mean, you're talking like, don't know the exact numbers, but I think it's somewhere close to 1 million contracts a day trade in flex, which, when we created them in 1993, believe me, those are not numbers we were fathoming what could ever happen.
Yeah. So this is something I might have even asked another guest or two this question, but I have a hard time getting to it. I wonder if you know the answer. These days, what percentage of all option trading is retail versus professional, institutional?
Yeah, that's a really hard question. I don't know if I can directly answer that. I mean, there's a lot of different proxies. One is just the name on of the firm that sends the order in. We used to say if it was Goldman or Morgan Stanley or Bank of America, it was institutional. If it was Charles Schwab and TD Ameritrade, it was retail. But that's not reality. I
Yeah.
mean, there's plenty of institutional at money that comes in through the more traditional retail names, and there's plenty of retail flow that comes in through the more traditional institutional names. But I think it's safe to say that retail has had a bigger impact on this volume growth in the last few years than institutional. And I think they both grown, but I think the retail growth has outpaced the institutional pace.
Hmm. Interesting. So, what sort of firms primarily use covered calls and cash cured puts? I mean, is it, and again, I'm just talking
Yeah.
firms,
Yeah.
but is it only like prop firms or is it also hedge funds or institutional money managers?
Yeah. I mean, so CBOE has a conference every year that I know you've participated in called the Risk Management Conference. And it's really where the market practitioners come. And it's, a lot of end money and institutional buy side, not the end clients themselves, but the people who are trading on behalf of these clients. There are a lot of firms out there now that are asset managers. That's the number one category that I would say are using particularly cash secured puts to generate alpha for their clients. Very consistent, put selling into the market every month, come out with these monthly brag sheets, not brag sheets, but their monthly reports, what they've done. And it's month, not every month is successful, but when you look back over the course of the year, in particular, selling cash secured puts has been a pretty good strategy. A nice alternative, definitely a better alternative than just traditional money market or T-bill type investing. Not all that much risk. Call selling. I think call selling, I don't know how much institutional call selling there is. I mean, I think there's brokers and advisors who have their high net worth clients, and in some cases, family offices, public and or private pension and endowments using call selling to protect either for income generation or some downside protection. But I don't necessarily know, I'm not in the business every day anymore, how many asset managers are running the pure strategy of call selling. I mean, I do know that there are some ETFs that are doing that. There's several of them. Most of the families of ETFs now have a call selling portfolio, against the S&P, where they're just selling. SIBO created the benchmark BXM, which is just selling the at the money 30-day at the money call every month, and we have back tested data on that back to I think into the 80s, 1980s, and has shown to bring down some of the volatility in a portfolio and generated some nice income if you do it consistently.
So, you think a lot of them are basically writing calls, but adding something more to it, more of a
Yeah.
complex way?
Yeah. So, one of the things that we did in my business development days at SIBO, and with the help of some of my team, was create these benchmarks. We had a great index team. We had some product development people. We had our institutional business development team talking to the clients. And one of the things that we learned, this is probably going back to the late 1990s, was by creating relatively simple benchmark type strategy indexes using options like the BXM or the PUT, which is just put selling, and doing that consistently month after month, not, very vanilla type strategies, and then giving those benchmark numbers to asset managers to use in their client for their client meetings. They say, here's the strategy. And then to your point, making a little bit of tweaks. So maybe instead of 30 days, it's every week, and or maybe it's even longer term or shorter term. Instead of exactly at the money, maybe they go 1% in the money, 1% out of the money, or some combination. So some way so they're using this benchmark, which is really important because almost all institutional clients want to see a strategy that they're implementing and tied to a benchmark, and then finding ways to outperform that benchmark. And again, sometimes they're successful at it and sometimes they're not. But the ones that are good at it are the ones that gather the assets. And I always used to say, and I still believe this, that the role of SIBO business development is to teach people the benefits of using options and getting those people who have money to give that money to the people who are professionals in their business and to use that and to implement the strategies that they've developed. And that's risk management conference is a perfect example of that. I mean, we spent a lot of time trying to get end user, particularly public pension representatives to that conference so they could just hear for 2 or 3 days at a time all the great benefits of using options in their portfolios and then hopefully turning that around and making an allocation to a specific strategy in a much broader portfolio.
Mm-hmm. And then trying to beat the benchmark.
Yeah, or at least match it. Yeah.
Yeah, interesting. The trading business attracts a lot of competitive people.
It does, but I'll tell you one thing about the last comment on risk management conference. My favorite part of risk management conference is just the coffee talk, because these strategists and these asset managers, they're not bashful about talking about how they use the products.
Mm-hmm.
And a lot of idea generation occurs. So you and I could be talking, and I'll tell you what I'm doing, you'll tell me what you're doing, and I'll run back to my lab and I'll make a little tweak to what you're doing, and that leads to more volume. So the more you get that kind of creativity together in one room, and you get the opportunity for these people to just talk about how they're using our products, and so a lot of it's anecdotal, but pretty confident in saying that those conferences brought a lot of new business to the exchanges, into our market making community for to trade against.
Yeah, the coffee talk is the best part. The one that I spoke at in Hong Kong, I met this guy who was asset manager, and he had this strategy that when he first said what the strategy was, I was thinking, that's whatever. That's a weird strategy. Why would anybody do that? And the more I ended up talking to him, I was like, wow, this is actually really, really smart. And yeah, it kind of changed the way that I thought about that particular strategy, which made me just question the way I think about a lot of strategies.
Yeah, I'm sure I know you've done a lot of speaking at a lot of conferences and engaged a lot of people, and I mean, you're the perfect advocate for the growth of the business because to your point, you heard that gentleman, you just spoke to that gentleman, you understood what he was doing, probably had not thought exactly of it from that angle before.
Yep.
And then you apply it to something that you're doing, and then you teach it to your clients, and we got a whole new universe of traders using a new strategy.
Yeah. Yeah. So they say you can take the guy out of the trading pit, but you can't take the trading pit out of the guy. And I think that goes for not just the trading pit itself, but kind of any aspect of the options industry,
Mhm.
especially when you've spent as much time there as you have. So you've always got interesting options related stuff that you're working on. What do you have cooking these days? Anything you can share with our listeners?
Sure, would love to. So you mentioned in my bio, a couple of things of my current ventures. The one that is most directly related to our industry is a firm called Adaptive Financial. And these are two gentlemen that actually met at Harvard Business School and unrelated backgrounds. One's a professor, was a quant and now teaches at BU. And the other one is just kind of a jack of all trades kind of guy, I like to call him. And they created this software which was just so perfect for what I love, which is basically takes an equity portfolio, uploads it into their software, and the software will analyze it and create a recommended trade using index options, generally using downside puts, but also call writing generation as well. And where we've taken this software most recently, which I find super exciting, is as a client, you can express to this software what equity exposure you want compared to like a traditional 60/40 portfolio. So let's say I want 80% equity exposure, 20% fixed income, and it will take your portfolio and make a recommendation tied to what view you'd like to see it be expressed. Getting back to what I was saying before, that options can be always used to get you exactly to where you like to get. The other nice piece of this software, and I'll stop here, is it will visually display after make its index put recommendation, if it's that's what you're trying to do. It'll display within a bar chart three things. One, the benefit of portfolio diversification, just natural diversification by holding multiple names across a portfolio. Two, the once you overlay the put, the amount of downside protection you've been exposed to. And then third, if you have outlier single name or two single names, because of just by the nature of your portfolio, it'll make a third recommendation of single name put buying or call selling. So it's pretty sophisticated. It's really fun. As you know, I mean, our job at CBOE Business Development was to get people to use our index products. So that's exactly what this product does. So it's really fun. Some of the other things that I've been doing, I've been working with you referenced Wilson Innovators. It's a firm, it's a one-man shop that a gentleman by the name of Vineet Wilson is plugging away at trying to better using AI, which is the first time I've actually been exposed to AI. And I can't believe we've been talking as loud as we have, and we haven't referenced AI yet to help acquiring firms better identify and target firms for acquisition. And very fun. And my experience at SIBO being involved with many acquisitions over the years is where I get to leverage some of that experience. So those are the two things that I've been spending a lot of my time on. Doing a little bit more trading than I ever did before. Have a little less restrictions on what I can trade because I'm not an officer of a major exchange anymore. So it's fun. It's fun to speculate a little bit. It's fun to do some pretty aggressive call selling on my portfolio, generate some income that way. Not super sophisticated at it. I'm sure you could teach me. I know you can teach me a thing or two, but I'm getting better at it. I've been doing a lot of I do a lot of call buying, just call spread buying. And one thing that I will tell you that as you do more, you get better at is figuring out how to exit. And I know we've talked about this before in some of our conversations. Exit is such a hard part of trading. I don't know. I certainly haven't perfected it. I never will. I don't think anybody ever does, but I feel like I've gotten much better at it. And I think that's just because I'm doing it more. Practice makes perfect, right?
Yep. Yeah. Exits. Exits. I had lunch with this one guy this one time who's a former market maker that I used to stand next to in, I think, one of the grain pits or something. And he was talking about how theoretical values don't matter. And I was like, wait, what? What are you talking about? Like that. And he's like, yeah, because really that just gets you into the trade. It's the exit that determines if you make money. Like that's the whole important part.
For sure. That's fun. I mean, it's my fun money. It's not, I'll go to sleep every night with what my portfolio looks like. But I also don't, but I also have some fun. So
Yep. Hey, man, you want to be good at something, you got to have fun with it, right?
yeah, absolutely. If it wasn't fun, then why do it, right?
So, yeah, in our professional and personal lives, we've done a lot of traveling together, gone to a lot of concerts together. Do you have any good trips or shows coming up?
Well, I've been on a show run lately. I just saw the Decemberists last
Ooh,
Sunday night out in Skokie, Illinois,
cool.
which is Decemberists is a great band. I really enjoyed that. Coming up, my wife and I have a couple big trips coming up. We're doing a Bay Area, Kauai, Breckenridge 2-week excursion,
Holy,
leveraging our United Airline benefits. So, and then we're later this fall we have a trip planned to Spain and France. Part of retirement or next chapter is making sure you get to see the world because we're at an age now where we can still do all this stuff, but live for the moment is what we'd like to think and say.
man, that sounds really, really great. So, Andy, thanks for giving our listeners sort of a day in the life of someone who's been part of the DNA of the options industry for decades. And also, just thanks for hanging out and sharing your time with us.
Yeah, good. I enjoyed it. And, I always enjoyed our friendship, and I look forward to continuing it. And I applaud all your successes, and I know they'll keep coming.
And that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And if you're already a listener, you can support the show with a paid subscription. When you do, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about in the podcast, subscriber-only posts where we drill down on a stock, event, or trading opportunity and share trade ideas. And you'll get my covered call and cash secured put trades that I'm making in my real brokerage account. And you'll get access to our monthly online Ask Me Anything webinar and much, much more. And the best part is your paid subscription helps keep this show on the air. So I'd like to take a minute to thank our current subscribers. Let's give a big thanks to Sean K, Steve D, Nan Ron, Glenn K, Ann T, and Jane, our newest subscriber. Thank you, Jane. As well as Alex H, Bill H, VJ, Paul P, Myron, Mark, Spencer, John D, Douglas B, Ed B, Christopher L, Deborah, and Eric G. To join this list of wealth building paid subscribers, just go to wealthbuildingpodcast.com and choose your subscription level. In the meantime, invest excellently. See you next time.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.